Tiga.
Assalamualaikum warahmatullahi wabarakatuh. My name is Ahmad, Rozani, Irfan. I'm from MB 47 Inter 2, and I will answer the case study 1 or case study 1. Sorry. From the question, we have the conclusion. First year cash flow is $40,000. Cash flow growth rate, or the symbol is G, is 7%. Initial investment is 650,000 dollars, and required rate of returns, or the symbol is R, is $14. 14%. So the question is, the first question is, if the done code requires 14% returns on such undertaking, should the cemetery business be started? So from the question, I will use NPV formula. The formula is NPV CF1, or cash flow first years, divided by R, or required rate of return, minus by G, or cash flow growth rate, minus by initial investment. Okay, I will calculate NPV cash flow. First year's cash flow is $40,000 divided by R is 0.14 minus by 0.7, and minus by initial investment is $650,000. So the next step is R minus by G is 0.7, and okay, the next step is I will calculate all of this. The calculate is minus 78,571.43, and this is the NPV. Okay, the conclusion for first question is the NPV of the project is a negative 78,571.43. So that means the project isn't viable if the company requires 14% return. 14% of return. So next to the second question. The second question is the company is somewhat unsure about the assumption of a 7% growth rate in its cash flow. At what constant growth rate would the company just break even if it still required a 14% return on investment? So the formula is to find the event point. We set the NPV formula to equal 0 and solve for G or growth rate. The formula is first year's cash flow divided by R minus G equal to initial investment. So the next step is the first year cash flow is 40,000 divided by R is 14% minus by G 7% or 0.7 equal to initial cash flow is 650,000. And the next step is I will move the 40,000 to the side. Okay. The next step is sorry. And the next step is I will calculate 40,000 divided by 650,000. So the calculate is 0.0615 and 38. Next step is I will move 0.14 to this side. And the calculate from 0.14 0.14 minus by 0.061 and 5 and 38 is 0.07846, and this is the answer. And the conclusion for question B is to break even or NPV equal to 0, cash flow must grow by at least 7.85% per year.
Assalamualaikum warahmatullahi wabarakatuh. My name is Ghifari Haikal, Afifi, and today I want to do question number 2. So, first of all, for the step 1, we need to calculate the initial investment. So, for the equipment cost, we got $14 million, and the net working capital, then WC, is $1.5 million. And for the total initial outlay, we got 15.5 million. Then the step 2, we compute the annual operating cash flow. So it is like revenue and cost. So for the revenue, for this section, we get it from the unit sold times $330. So we got this month of money from the year 1 and year 5. And for the variable cost, from the unit sold, we times with $210. And for the fixed cost, we got 750,000 per year. It is from the questions. And for the depreciation, the 7 years mark MACRS. For the year 1, we got 14.29%. Year 2 is 24.49%. For the year 3 is 17.49%. Year 4 is 12.49%, and last one is 8.93%. And also we get the depreciation is 2,600,000. And for the year 2 is 3,428,600. For the year 3, 2,448,600. Year 4 is 1.748 and 600. The last one is 1.250 and 200. And for the taxable income and taxes, it is 35% rate. So how do we get this EBIT? For the EBIT is the revenue minus the variable cost, minus the fixed cost, and also minus the depreciation. So we got this amount for the year 1, year 2, year 3, and so on. And for the taxes, so the EBIT we times with 35%. And also the net income, it is from the EBIT minus the tax. And also for the OCF, we got from the net income plus the depreciation. So we got this amount of money from each year. The next step is we change in net working capital. So the sales increase, we get it from for the year 1, we get it from the sales increase from year 2 minus the year 1. And we got it like 3,960,000. And for the year 2, it is from year 3 minus year 2. And we got 990,000. And for the year 3, it is from year 4 minus year 3. We get 660,000. For the year 4, it is from year 5 minus the year 4. We get is minus 8,910,000. And for the NWC added, so we get it from the sales increase. We get it from the sales increase times with 20%. And we got this amount. And for the total NWC, so the the year 0, we got 1.5. And then for the year 1, so the 1.5 we added with the 792,000, so we got 2,292,000. And for the year 2, we get it from the 2,292,000 add with plus with 198,000, so we get this amount. So for the year 3, so the total NWC from the year 2 plus the NWC added with the year 3 equals 2,622,000, and 262,000 we minus the with 1,782,000 equals 840,000. Yeah. And then next step is the salvage value after tax. So for the book value year from the year 5, it is 14 million minus 10,876,600. It is the total depreciation, and it equals 3,123,400. For the sale price, it is 30% of the 14 million, so it equals 4.2 million. And the tax on gain is 4.2 million minus 3,123,400, and then times the 35% equals 776,810. For the after-tax salvage value, it is 4.2 million. 4.2 million minus 376,810 equals 3,823. I mean 3,823,190. After that, the next step is free cash flow. So from the free cash flow, the formula is the OCF minus the delta NWC plus the salvage value. So it is like this. We get this amount, and the total for the year 5 is 11,243,260. So the next step is calculate the NPV and IRR. So for the NPV, I'm working it on the piece of paper, so I will add it to the desktop or something. And for the NPV I got is 1,037,302 million. And for the IRR, I'm using the financial calculator, and I got 32.5%. So the conclusion is the project has a positive NPV, which is 1.37 point. So the project has a positive NPV, which is 1,037,302 million, and an IRR is 32.5%. So it is exceeding the required return from 30%, and it's indicating it is financially viable. And maybe that's it from me. Assalamualaikum warahmatullahi wabarakatuh.
Hello, my name is Zaky Pancapana. I'm from group 7. So today I'm going to solve the case number 3, which consists of uh, 4 parts. So which is part A, part B, part C, and part D. So for the first one, so we've got the summary that I have summarized from the question itself. So we've got the first one. First of all, we've got the initial investment, which is 570,000, which include of equipment, which is $510,000 plus 60,000 of NWC. For the annual production, we've got 170,000 cartons. For the variable cost, we've got $8 per carton. For the fixed cost, we've got $160,000 per year. The tax rate is 35%, and the required return is 16%. The project life is five years, and the salvage value is 40,000. So all of this summary will be used in the calculation below. So the first one, we have to find the annual depreciation, which is we've got from the 500, we've got 510,000, which is from the equipment, and divided by 5 years, which is the project life. So we will get 102,000 per year. And the second one, we have to find the depreciation tax yield, which is 102,000 times 35%, which is the 35% we've got from the tax rate, and the answer will be 35,700 per year. The third one, we gotta find the operating cash flow, which is the formula is bracket P minus 8 bracket times 170,000 negative 160,000 times bracket 1 minus 0.35 plus 35,700. And the fourth one, we have to find the terminal cash flow. So we've got 3 main point. The first one, we've got after tax salvage 40,000 times 1 minus 0.35, which is 26,000. And for the NWC recovery, we've got 60,000. For the total terminal cash flow, we've got 86,000. And after that, we have to find the NPV equation, which is a 0 equal to minus 570,000 plus operating cash flow times 3.2740 plus 86,000 divided by 1.16 to the power of 5. So for solving for P, for the price, break-even price equals to $10.07 per carton. So which is if the bid lower than the $10.07, so the NPV would be negative, meaning the project will destroy the value. Thank you. So for the part B, we have to revise the operating cash flow. So from the 10.07 into 11, because from the theory is the NPV and surplus value. If actual price bigger than bid price, project will generate surplus return, and it will lead to positive NPV. So when we use the operation cash flow, the plug will be P equal to 11. So we are using the $11. So the operating cash flow equals to 11 minus 8 times 170,000 negative 160,000 times 0.65 plus 35,000 700,000 equals to 26 263,200. So for the NPV calculation, we've got negative 570,000 plus 263,000, 263,200 times 3.2743 plus 40,000 and 947. So it is equals to 332,743. So uh, so what is the meaning of the answer here? So for the strategic insight, the pricing power, if uh, the minimum, the what is it called? The price is 0.93 premium over 10.07. So it generates significant value. And for the flexibility, so it allows room for discount to secure the contracts, such as investor appeal, for if the positive NPV makes the project, it attract it will attract the stakeholders. And for the break, so to find the break even quantity at $11, first one we gotta find the NPV equals to zero with the price equals to $11. Required of operating cash flow remains at 161,560. We have to now we have to solve the quantity. So first of all, uh, for the calculation is 161,560 equals to 11 minus 8 times quantity negative 160,000 times 0.65 and then plus 35,700, which is 117,177 units. And then so uh, what we can conclude from this answer is the sales can drop by 30.7% from 170,000 to 117,177 before loses before the lose of the project happening. And the next one is uh, we we have to set the NPV by by using operating cash flow equals to 161,560. So first one, we have to solve for the fixed cost, which is 161 and 560 equals to 11 minus 8 times 170,000 negative fixed cost times 0.65 plus 35,000 and 700. So it is fixed cost equals to 360,000 and 369 per year. So we can conclude that a fixed cost can nearly double from 160,000 into 316,369. So before it becomes unprofitable. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Kinan Faturrahman. My name is 1410401234048 and today I'm gonna explain on case number 4. So we got the project summary here. So we start with an initial investment of $16.3 million, and the project will run for 7 years, generating $5.44 million annually in operating cash flow. In 7 years, we also recover $900,000 in working capital, giving us a final year cash flow of $6.34 million. So how do I get this numbers? So for the NPV here, I found the NPV by calculating using the standard discounted cash flow formula shown here, which is this one. We discount each year's cash flow at the 14% cost of capital and subtract the initial investment. So the result is a positive NPV of $7.39 million, which is shown here. I rounded up to become 7.39, but the true number is $7,388,052. So the next is IRR. So IRR is the discounted rate that makes the NPV exactly 0. Using financial tools, we solve this equation and find an IRR of 27.59%. Since that's well above our requested, which is 14%, the project is very attractive. And last but not least is the payback period. And I counted the payback period with this formula. We look at how long it takes to recover the 16.3 million. After 2 full years, we've recovered about $10.88 million. And by partway through year 3, we break even. Using the formula, we find the exact payback period is 3 years. So the summary of this project is financially viable and worth pursuing because it's profitable. From the NPV, it shows positive numbers. The IRR, it shows above our minimal percentage, which is 14%, and we got 27.59%, which is a good project. And the payback period, we will, what is it called? We'll break even at 3 years, and that's include pretty early for a project this big. So the summary is the project is financially viable and worth pursuing. That's all from me. Thank you for your time.